In this video, traders, we are going to look at, should you always scale out of a position? Stay tuned. Hey traders, warm welcome to you. All right, so when we are deciding to trade, very often we have the decision whether to scale out of a position, take everything off, or scale out. Scale out being that we take off part of the position. So as if we have $10 a point on, then we might decide to take off 5, might decide to take off 1, might take off 8. We've got a lovely kind of different ways that we can play around with that position. Now, what's worth pointing out, guys, that this video is sponsored by Core Spreads Australia. Go and check them out. There's a link to those in the description below for your spread trading. And why do I mention that now? Because if you were trading some of the markets that they offer on the exchange, unless you've got a large bankroll, you don't have the ability to scale. So it's very fortunate that we have access to these type of platforms and these type of brokers that allow us to do this. For example, crude oil, $10 per tick. So literally 1 cent move, one contract on NYMEX would be $10 per tick move. Now that's a big move. So you really don't have much chance to scale unless you've got a big bankroll. Let's say you wanted 10 scales, you're doing $100 a point move or a cent move. That's a lot. Of course, if you're trading with Core Spreads Australia, you can do $10 still then, but you can come out and scale out, or you can do $1 if you like. You can go right down and still get access to these markets. Same with markets like the DAX, guys. Big contract size, silver, big contract size. You know, having an account where you can trade smaller size, but then when you start to increase your trading size, gives you the scaling ability, gives you so much more flexibility. It makes life so much easier for you. In my opinion, I think that it's far easier when you've got the ability to scale, because hey, even if you don't want to scale after this, you might go, no, I don't want to scale at all. But even if you don't want to scale in and out of positions, you can still go all in, all out. But it gives you the opportunity, gives you flexibility to both adjust position size down to suit a smaller account and to kind of chop pieces out and tranche it out as the market is moving. All right, so look at the pros and cons to scaling. So scaling, what's the advantage of scaling? Well, there's an advantage you don't have to be right. In other words, you can be half right. What do I mean by this? So let's say you have a target up to the high side, and let's say you're going to scale out as it kind of stalls in places as it goes there. Now you can scale out a little bit more, and then it comes down and you get stopped out of your last quarter of position, you still make money. Now if you're waiting right until that final target to be right, then you've got to be exactly right to make money. It's a binary event. You either get your fill or you don't. Whereas you can be a little bit more dynamic with scaling. You can kind of see the market stall a bit, piece a bit out, wait a little bit longer, comes back, goes up, stalls a bit, piece a bit more out. You can be a bit more proactive with it. And one thing also that does, guys, is it helps you mentally, because how many times have you been in a trade where you've gone, or maybe you've not started trading yet, but if you when you will, you'll be in this scenario where, okay, it's nearly at my target. I want to take the profit. Do I take the profit? I want to leave money on the table. Oh, what should I do? I don't want to lose this. It doesn't look that great. It kind of looks like it's stalling a little bit, stagnating, and you're kind of there, but pros and cons, you're looking back and forth. And it's very tricky. The easy solution is to be able to just go, boom, okay, well, I'll just sell some. I'll sell half. You know, very easy to kind of put yourself in a more comfortable position whilst still giving you some upside. So there's definitely a mental benefit to it as well. Okay, the other thing is just you can scale at key levels. So let's say you were looking for an extended target, for example, but there were a few hurdles along the way. You can scale just before those hurdles quite comfortably. If you had a whole position on, you've got to wait for it to overcome that, to overcome that, to overcome that, to finally get to your final target. So naturally you either go, well, I'll just take a scalp on that, and then you end up leaving more on the table. Then you kind of adjust the trade out of either fear or greed gets the better of you. So being able to scale out those key levels is quite handy. The other one, guys, is you can leave a runner. So you don't always have to kind of piece it out into tenths or quarters or whatever. You can say, right, if you're doing $10 a point, for example, you get a nice move, you get a nice 50-point move, you take 9 off, 8 off, and go, you know what? I'm going to leave 2 running. I'm going to leave a stop loss in, put it on the platform, put my stop loss in, I walk away. I know I'm protected within certain parameters of stop loss, and then, hey, whatever happens will be. If I come back and get stopped out on a 2, it's not the end of the world. I took the majority out, $8 a point out. If it carries on running and running and running, I've got a nice little piece left that I can run and take another one off, etc. as it goes. So, you know, you leave got a bit of flexibility to maybe capture one of those big trend moves that you might not otherwise trading your full size. The other thing is it manages risk better. So this is, if you think about the market goes in your favor, let's say it pulses in your favor very quickly. Now you could take off half the position there, and then you can bring the stop off on the other half, and all of a sudden the risk is dynamic has changed completely. Now might be even get into a position where it's now a trade that has no risk on it. If it's moved up, a certain amount, you've taken off half, and your stop is equivalent of what you've just taken on the other half. It's now a risk-free trade. So you have this ability to manage the risk better. Maybe you kind of just take off a lot on the first impulse because you find yourself very good at picking those first impulses in markets. Then you can take a lot off and leave some on to see if you can get a little bit more mileage out of it. So the flexibility really does allow you to do a lot of different things. Okay, so let's look at the downsides, because it's not all, as a markets guys in trading, this is not sort of silver bullet for everything. The downside is that you potentially leave money on the table. If you've got a target up there and you're constantly piecing out, tranching it out as it's going up in your favor, every time you close a little bit of position, of course, you are reducing the position size, so you're reducing the amount of money you're making as it continues to go in your favor. So the argument is that you're leaving a lot of money on the table. If you're scaling out too soon and you're too eager to kind of bank the profits, when you do get on one, you're never on one with a decent size because you've scaled out too much. The other thing is, a lot of people say a target is a target. Listen, if you've done your due diligence and your analysis and you think it's going to 50, you think it's going to 60, whatever it may be, then taking it out earlier, it's kind of going against some of the analysis that you've done. Now, I see the argument for that, but I just want to counter that for a moment, is that, markets are very dynamic. Markets change. Markets do different things and then always go to plan. And so, just playing devil's advocate or just giving a counter argument, you can probably see which side I'm on, giving a counter argument to that is that, a target is a target, and it makes sense to try and hold as much as possible for the target to get the most juice out of the trade that you can, definitely. But if conditions are changing, if something's telling you, hey, it's just not there, it's just not, then having the ability to scale does help. But appreciate that's a very sensible argument against scaling. It's scared trading. So what does it mean by scared trading? Well, the argument is, listen, if you're going to take a position, you hold the position until you get to your target. If you're scaling it out and you're grabbing bits and pieces, it's very scared trading. You're never going to get those big boosts in P&L to bring that account equity curve higher. And there's a valid point to that. If you're constantly overscaling, if you're overdoing it, and you're grabbing and snatching stuff, that's no better than taking profits early. It doesn't really undo that. And if you're kind of just grabbing and leaving a little bit, it doesn't really help matters. There could be a sensible way of doing it, like taking some off, but still leaving a decent chunk so that when you're right, you're still getting paid for being right. And there's something to be said that, if you're only leaving a little bit on, then would you not take that anyway? And there's loads of different things around that angle. All right, the final thing, guys, is you're the lightest in your best trades. And this is probably the most valid reason out there. When you are on a really good trade, one of those ones that comes around every couple of weeks, a real runner, you've got it, you've nailed that low, you've nailed that high, and this thing's running and running and running and running. If you're scaling into every little pulse, you end up being so light in the trade that's working the best for you that it doesn't really do any favors. So the point here is your lightest and your best trades. Is the trades that go in the furthest ends up being the smallest trades, as in position size, because you've scaled out of it. And the flip side could be, well, if I've got a full position and it goes against me, I get stopped out, I'm getting stopped out in full size on my bad trades. So there's something to be said about that. So the answer really, in my opinion, and again, very, very much depends on the time frame you're trading, the asset class you're trading, the market you're trading, all that kind of stuff. It is to use scaling to your advantage. And if you're using a platform, like Core Spreads Australia, you have that ability. You're able to do that rather than going direct to the market and trading on NYMEX and paying $10 a tick and whatever else other big kind of futures contracts are out there. You've got that ability, and so you can imagine sort of three scenarios I've got for you here. If the market's plodding on up, then that's fine. We can just scale stuff out, and yeah, if you had the whole lot on, you probably would have done better. But there are scenarios like, imagine this scenario here where the market may well end up where it was before, but the market doesn't always go in a straight line, guys. In fact, trend days are relatively rare. If you look at the statistics, trend days, especially for the equity market, are super rare. More than likely, they kind of move back and fill consolidation, range bound, mean reversion type stuff. So if you're looking for extensions all the time, you're going to be disappointed. But let's look at this scenario. if you were here and you're kind of scaling one out here, you scaled one out here, maybe, again, you can take it an extra level and go, well, I'll stop out of some here. I'll bring a stop up on some, but I won't on others. Or maybe even you add back on your scale. That flexibility, that dynamic ability to adjust the trade just gives you opportunity to kind of perform a little bit better, and then maybe you scale out some there, some there. Maybe then you've scaled out most of it, you're left with a $1 left on, comes all the way down, and you don't care about it because you're in from down here, and you can stomach that big pullback because you've taken a lot of profits off the table, and eventually it pops up and gets your final target. You probably wouldn't want to be, if you're in a full boat, to sit through all that and see all that profit go back. You'd probably be ratcheting the stop up, and you'd probably be getting stopped out on some of these pullbacks. So listen, it's no silver bullet. You can ruin the trade with scaling. Certainly that is the case. But if you have a plan, you have a strategy, the ability to scale, in my opinion, definitely gives you a little bit more advantage and a little bit more flexibility to get the trades that you want. Anyway, guys, this video is sponsored by Core Spreads Australia. Go and check them out. There's a link to them in the description below. I'll see you in the next one. Take care. Bye-bye.